Here's the latest coming in on China's economy. In a new development, rating agency Moody's has given a new shocker to China by slashing its outlook on China's credit ratings to negative. The move comes as the agency cited risks regarding China's persistently lower medium-term economic growth and ongoing crisis in its property sector. The agency did retain China's A1 long-term issuer rating, but warned that the country's annual GDP will slow down to 4% in 2024 and 25. The agency's cut in outlook comes as China struggles to come out of its debt crisis and economic slowdown as well. Now, after Moody's new development, China's finance ministry was also quick to express its disappointment. The ministry says that it is unnecessary for Moody's to worry about China's economic growth prospects. It further adds how the country will remain an important engine for global economic growth in the future. Now, despite growing concerns about China's property sector crisis, the country remains confident that impact of property sector slowdown on budget is controllable and structural. We bring you a report.
Moody's cut its outlook on China's government credit ratings on Tuesday. The ratings agency downgraded it from stable to negative. It reflects global worries about China's economy. Moody's said it sees growing evidence Chinese authorities will need to give more financial support for debt-laden local governments and state firms. That, in turn, the agency says, risks China's fiscal, economic and institutional strength. It's also cited an ongoing crisis in the country's property sector, where giants like Evergrande have huge liabilities. After the statement, a source said China's major state-owned banks stepped up dollar selling. The move by Moody's was the first change of its China view since it cut its rating by one notch 6 years ago. The agency said it expects the country's annual GDP growth to slow to 4% next year and in 2025. It also expects growth to average 3.8% from 2026 to the start of the next decade. China's finance ministry said it was disappointed by Moody's decision. It further said the economy will keep its rebound and positive trend, and property and local government risks are controllable.
Let's also break down for you what Moody's outlook has been like. Remember, this is big news because earlier Moody's credit rating for China's credit rating was it remained stable, and now they have downgraded it to negative. So this is the big development as far as Moody's outlook is concerned. It's retained the A1 rating on sovereign bonds, something that China had gained back in the year 2017. The GDP, according to them, is slowing down to 4% in 24 and 25. As well. At the same time, it says that there will be a further decline in the GDP, that too by 3.8% on an average between the years 2026 and 2030. But they say that what is driving this entire decline in these dipping GDP figures is demographics. Yes, we all know that China's government has been doing a lot. They've been providing policy incentives. They've also been resorting to propaganda to, in fact, coerce the population overall in the country to have more children, only so that the demographics can look up. But is that enough to sort of rescue China's economy at the moment? Let's try and get in a sense of perspective. And for that, let me introduce my guest today. I'm joined in by Sultan Megji, who is the former Chief Innovation Officer of the Federal Deposit Insurance Corp. He's also the Adjunct Associate Professor of Engineering at Duke University. Thank you so much, Sultan, for joining in. Now, China's Finance Ministry has come up with a very strong rebuttal. They're saying that Moody's concerns are unnecessary because the impact of the downturn in the real estate market on local general public budgets and government budgets is controllable and structural. How much do you agree with the response coming in from China's finance ministry?
Well, I suppose we shouldn't be surprised to hear such a strong response from China. You know, one of the largest issues that we have at the central bank and at a macroeconomic level with China is how opaque their internal central bank infrastructure is, and especially at the municipal level. So, you know, in the face of this downgrade from Moody's, I guess I'm not surprised at all, but it does speak to the fact that, you know, these are estimates by an outside party, and we don't really know the impacts, and we don't have a lot of visibility like we do in other nations like India, like the United States, and in the EU.
Right. right, Sultan, we are also not aware of any kind of stimulus packages being provided by their government. At the same time, we all know that there's a rising unemployment as well at the same time. So is China doing enough to reduce this reliance on infrastructure and the property sector for growth, something that has also been advocated just last week by China's central bank, but we do not see anything in the development?
It's a great comment. We don't know if this is going to be enough. In a very short amount of time, really less than 2 full generations, China went from a primarily agrarian economy to attempt to be an industrial information-based economy, and they haven't made it all the way through that yet. And so these big infrastructure projects have been a huge underpinning of their economy. And I think Moody's rightly points out that in the face of these kinds of decelerations on the economy, a lot of the other programs the Chinese might want to do are going to struggle. And I for one would be looking for a significant stimulus package from the Chinese government focused on domestic transformation.
Sultan, whether it is the decline in demographics, which we know is a result of China's own one-child policy of the past in the 90s, or its zero-COVID policy that nosedived tourism and growth, is the Chinese economy also bearing the brunt of Communist Party's own misguided policies?
Asking an American about the Communist Party is always going to be interesting because it's hard for me to say something nice about it. Overall, the Chinese Communist Party still has a stranglehold, and there are limiting factors, whether it's the United States and EU working with others to ensure that advanced technologies don't take root in China and take root in democracies, or its demographic issues, or its import-export issues, or its lack of US dollar cash reserves. There are a variety of these issues that the Communist Party are roadblocks that they are putting in place that is going to strategically limit the ability of the Chinese to have the broader kind of economic impact they want.
Sultan, my last question to you. How much of an impact has the ongoing trade war had between Beijing and Washington, something that we've seen in the past few years? But when we talk about China's economy per se, how much of an impact has this trade war had, especially when it comes to technology and semiconductors?
It's a mixed bag. There have been some battles won by each side, and some battles lost by each side. And I don't like calling it a war. I would prefer to call it a game of chess played by one side and a game of Go played on the other side. And there's going to be winners and there's going to be losers. Right now, the Chinese economy needs advanced technologies to have that kind of geometric change to the economic activities. And it is a strategic program of most democracies to not allow them to have it. And so until that's resolved, this conflict or game of chess will continue for a few years.
All right, I think you summed it up pretty much as has been in the media reports as well. Many thanks to you, Sultan Megji, for joining in with your precious insights. Thoroughly appreciate.
Thank you.
And that brings me to the end of this newscast. Thank you so much for watching CNN News 18 Global.